Atsi Sheth, Vice President and Senior Analyst at Moody's, joins in from Singapore. Atsi, it's good for us that you are in Singapore. Doing phone interviews from New York was not fun. But first up, your thoughts on both these numbers, IIP and CPI. Good, bad, indifferent?
I think I'd agree with your characterization, Lata, that they were not that far off from the trend we've seen so far on industrial output. As you said, there was a higher base effect to contend with, so we should have expected some deceleration on a year-on-year basis. And on the CPI, yeah, the headline number didn't move much, but core CPI, that's non-food, non-fuel, inflation certainly seemed to be trending lower. So I think from that perspective, the expectation that industrial output will remain in recovery as the year progresses and that inflation might trend down slightly, I think that expectation was supported by these numbers, quite frankly.
All right, that's good to hear. Atsi, hi, good morning. So what would your target be for the core CPI number, say for the next 3 to 6 months, as well as for the overall inflation number? Do you expect it to fall much below this 7.8% level?
I think there will be a time again when base effects will come into play. As you know, last autumn, CPI had creeped up. So that might help the headline number. Our sense is that, the 8% mark for headline CPI by the first quarter of next year, inflation will come out somewhere around that, maybe a little bit above, maybe a little bit below, but 8% seems like a very safe forecast to make at this point. And we had assumed that that would come with the core, the non-food, non-fuel, dropping a little bit below 7, and that seems to be what's happening, and we're sort of sticking with that forecast for now. I think one thing that is helping the CPI inflation forecast is the fact that the monsoon did come back a little bit towards the end of the season, and that might bode well for food prices. So you might see that helping the headline number as well as we move into the first quarter of next year.
Okay. Atsi, the more important macroeconomic development has been the way in which crude has fallen. That makes India's twin deficit way, way more manageable. 4.1% was bravado talk when Arun Jaitley first said it. Now it looks eminently achievable. People are almost factoring it in as a given. Current account deficit will become perhaps a smaller problem if our exports don't suffer so much because of global slowdown. Is India in for a rating upgrade?
Lata, you asked me this question on the other side, the flip side, about a year ago. And our answer remains sort of similar, which is that, you have to look at the rating on a relative basis. So it's not just India's performance vis-a-vis itself over the last year, but vis-a-vis other countries that we rate, and there's over 120 of them that we rate. And in that sense, if you look at where relative metrics in India stand, growth has, even when it was slower, was higher than its similarly rated peers. That remains the case. In fact, we think the gap will widen a little bit. And inflation and fiscal metrics, even with the improvement that we're forecasting, they remain weaker than similarly rated peers. So I think the balance of risks hasn't changed. And again, the rating is really a comment on credit risk, not just on growth or one or the other macroeconomic indicators. We think the balance of risks remains about where the Baa3 level says if they are, and that's why we maintain a stable outlook at this point.
Okay, let me ask an academic question. What would make a rating agency upgrade India?
I can only speak for ourselves.
Sure.
That's Moody's, and I think that's a very good question to ask. There's 3 things that are constraints on India's rating at this point, and I'll just list them and then talk about what could make us change the rating outlook or the rating itself. The 3 things are well known. One is the fiscal position, that government debt to GDP is higher than peers. The fiscal deficit is much higher than peers. The second is inflation, again higher, and this constrains competitiveness over the long run. So that's why it's a constraint on the rating. And the third is India's infrastructure. This is so much weaker than comparable countries, and you saw the Global Competitiveness Report that came out a couple of weeks ago. This again reinforces that point. Our sense is that if there's a movement in these 3 factors, and this movement is likely to come together, if you address infrastructure constraints, you remove supply-side constraints on inflation, you improve growth prospects, that helps your fiscal. So we think that there is a chance that all 3 metrics could improve if policy action and global conditions are both cooperative. And if that happens, indeed, I think India's outlook would improve because these constraints would be removed, growth potential would go higher, all the constraints would then seem less weak than they are right now.
All right.
Less of a constraint than they are now.
Well, perhaps it's right on cue, Atsi. We have Governor Rajan getting ready to address the media at this point. So I'm going to squeeze in one last question before he starts. What do you think he will do on the 20th of or 30th of September? Do you think he'll hold and wait to see more data on inflation?
I think the RBI themselves have been very transparent about this, that inflation remains elevated. The conditions that would support a significant slowdown in inflation are not yet evident. So I don't think that there will be significant rate movement downwards, at least until there's more clarity on how far and how low inflation is going to head.
Okay, actually, our team is listening to Rajan, and he's at the moment talking about the distress situation in Kashmir. So we will get back when he talks more market-moving stuff. Of course, a huge emotional problem, but we can keep Atsi for a bit more. Atsi, just to develop on what Sonia asked you, therefore, when is the next rate action, and what will be that? I think that the market consensus is for a prolonged hold in rates from the RBI's standpoint. And I think that's a very reasonable forecast to have because while everybody does expect inflation to trend down, I think it's still elevated. And we're looking at 8% early next year. But the 6% that has been, cast as the sort of target for a couple of years from now, that is still not yet evident. So I think that a prolonged hold makes sense. And I think, again, three things have to happen for rates to be cut. One is clarity on fiscal direction, whether indeed not just the headline deficit comes down, but whether current spending will be reoriented towards capital spending. I think that's an important. The quality of fiscal consolidation will be an important trigger. And then, of course, the other things like crude prices, the exchange rate, and agriculture, all of which are looking a little bit more benign now than they were, say, 6 months ago.
All right. And what about your expectation as far as WPI is concerned? It's just going to come out in about 2 hours from now. Any thoughts there?
Again, I think the WPI, people pay less attention to it now that the RBI focuses more on the CPI, and perhaps justifiably so. But I think the trend there has been even more benign, that it's been trending down. And we think that, either stability or a slight uptick down. But again, I don't think that is what will influence monetary policy action, as again, the RBI themselves have said. But I think the WPI tells you something about where costs are going for, producers as well, and what costs they're passing on. So I think it's an important signal that in general the Indian economy is looking at some sort of easing of pressure on margins, easing on pressure on purchasing power because of the trending down on inflation.
All right, Atsi, we'll leave it at that. Thank you very much for joining us with that many-sided perspective of the macro numbers that came and, of course, the macro scene in general. But I think the key takeaway from a person who represents rating agencies is that no rating upgrade till inflation falls. I mean, I think that gives the government good reason to support Raghuram Rajan.